Okay, we'll try to start the afternoon session. Come on back. Doesn't matter, I'm ready.
Are you going to be starting now, in a minute, or right now? I think there was a question.
Okay, so we'll start our afternoon session. Okay, what we're going to do, at least for the next hour or so, is to give you like a little bit of a walkthrough of what a working paper would actually look like from start to finish. But the one that's in your handout isn't obviously a fully completed one there, but it will help you in aid because you do have to do an assignment on a compilation file. So we'll try to give you a little bit of the nuance with where you actually did see it. We did extrapolate something, like we showed you what the review engagement looked like, we showed you what the profile looked like. So we're going to go through the actual concept of actually doing a file. Once we're satisfied that we've done an engagement and that we have sent out the engagement letter there.
Actually, Bruce, just to stop you for a second, for those that are online, we're not going through the PowerPoints right now. So what page are you on, Bruce? So that
Told you, appendix, part 3 appendix.
Okay, so we're at part 3 appendix.
Yep.
So Ellie, if they have any questions, let us know, and hopefully they'll be able to follow along. And as Bruce has indicated, what we want to do is we just want to focus without going back and forth between a review and an audit and a compilation, just a compilation, especially for those that don't work in public accounting. You walk away today and you might not be able to do your case study, or you might not be able to actually put a file together that gets you through practice inspection. So let's see if maybe we can address and give you more of a walkthrough, as Bruce said. Great.
Okay, so as I said, you got a particular client, and now you're going to have to do a working paper file. You know, the other format is, where do I start? Well, we talked about earlier about your obligation to do a takeover letter, your obligation to actually figure out what type of engagement it is, and the second thing is also to actually get a engagement letter. What this is going to show is what's actually included in the file. And the best way that we've always done them previously, like most accountants there, we figured that the easiest way to control a file is to have that file controlled by what we really actually call the working paper index. The components of the working paper index will be the file completion, the financial statements, the planning information. A little more cumbersome this way.
Yeah.
The detailed general work there. And then what we do is we actually break up the groups of what we classified the financial statement components. You can actually come up with any which way you want to do to codify them. At this long, what you have to establish is uniformity within your particular practice. Historically, and especially if you take a working paper generator, if you took like caseware or whatever, these are actually always predetermined. Single letters alpha is usually to designate the assets. Double letter alpha is usually to designate the liabilities, like
and shareholders' equity
and shareholders' equity and repay. Okay, so like just think of a normal financial statement and look at the components thereof. Oops.
Okay, so Bruce is just giving you a little bit of an overview and guidance to say to use your index more or less as a flow chart to kind of follow through what you're going to be doing. But remember, to get to this point, you've already met with the client, you should already have your client profile completed, you should already have determined that you are engaged with them and an engagement letter completed. If there's a takeover letter, you've sent the takeover letter. Preferably you've received one back, and if it is a new client, you got the prior year's information and records. If you are working with software that's used to generate financial statements and working paper software, then it may make it a little easier, but you need to know where to go and what you're doing and how that actually flows through. Okay, the file must be indexed. How many people in here don't know what I'm talking about in terms of indexing your file? Okay, so that's pretty good. No questions about indexing. So you basically want to be able to indicate where the information is coming from and where it's going to. And so you'll be able to see that at the bottom of the page, the index of that particular page. You'll be able to see that the balance that refers to cash is in section A, right? And that's really what he was giving you. He was giving you an overview as to why we use the single letters and the double letters. It doesn't have to be that way. You can use something entirely different, but people need to know exactly what you've used and be able to follow it in your particular file. So once we get to this point and you're engaged, you got your engagement letter and all of these things are in place, obviously where are you going to start? You're going to start with cash, right? And you're going to go down each one. So we're doing a compilation, all right? And so now you have your cash balance of X dollars. Now what you're trying to attempt to do is you're trying to ultimately determine, is that cash balance reasonable? Is it false or misleading? So obviously, what kind of work would you do in the cash section? Could we get participants to kind of help out in this, and we'll see where we're going with it?
Well, one of the things I would do in my experience is to always do a reconciliation of the company's bank account and to attach the actual bank statement to the working paper to indicate evidence that this balance matches with what's showing on the statement.
Okay, that's an excellent response. One of the biggest mistakes that people will do is they'll actually do that, but not put it in their file. They'll leave it at the client office and not include it as part of the file. So what we want is we want you to be able to do that. If the reconciliation, Tony, already exists, you would only take that information. But if the reconciliation doesn't exist, then you would obviously perform a reconciliation to make sure that that number has reasonableness and can be relied on. So basically what you will do is that will form part of your evidence in your file. So you'll have your cash lead sheet. Behind that, you'll have your reconciliation. Behind that, you'll have a copy of the bank statement. And if everything's okay, you move on. What's next? The next thing is what? Receivables?
Let's get the cash first.
Well, no, I'm just saying.
Okay.
That's,
Okay,
you want to add something, you can add.
agreed. Okay, but like as your cross-reference, as you can see, you start off with a preliminary. Did you make any adjustments? Did you just happen to reclassify? Do you understand what reclassification is?
Can we get responses on that? What's a reclassification?
Gotta get the mic.
Anyone?
Well, where the the client has it basically in an account that isn't proper, so you as the professional accountant would reclassify it to where it's supposed to be on the balance sheet or P&L.
Okay, what's the difference between that and an adjustment? Question or answer here. Yeah, there's your mic. Oh.
Hi. An adjustment is when something is incorrect and you need to correct it. A reclass is where the balance may be correct, but for financial statement purposes, it might be on the wrong side of the balance sheet, for example.
Okay, so it's not recorded in the records of the client. It's only an adjustment that's made for financial statement purpose, correct? That's the difference between the two. Okay, good.
Your best example is a credit balance in your accounts receivable. You may want to reclassify that from a debit to accounts receivable to a credit to accounts payable. The same idea if you have a debit credit, you're not supposed to offset them. You're supposed to show the total asset and the total liability. So in the account that you have. The only thing you're allowed to net, for argument's sake, would be accounts receivable minus the allowance for doubtful accounts.
And that's a contra account, obviously.
That's right. So you flow from your original information. The adjustment is whatever adjustment you had made or a reclassification to get to what they call the rep, and that's a representation. The annotation that should have been done here is where did that information come from? In other words, what is the background information? So the background information is coming from the next page. So your next page there, the fact is I actually did perform a bank reconciliation that I started off with the statement balances. I did my adjustments to come up with the GL balances. and I list, in this particular case, the outstanding checks.
Yeah. So basically, this is incomplete in terms of indexing, right?
Yes, there's
So
no indexing.
There is no indexing. So two things, if you go back to the previous slide, what Bruce was indicating is that you would indicate beside the cash that would come, say, from A1.
In the
But you would
annotation.
also, in the annotation, but you would also indicate that the total balance would go to the financial statements, FS. So
Okay,
That-
let's not
that's
assume. Do you
important.
understand what that means? We're going to reference the next page, H2, the ending balance for GL, the 41,890.86. We're going to say, where does it go? To A. Then over on A, we're going to put right there, where it says annotation, where do we find that information? A.2. Or if you use the normal terminology, you're going from the cradle to the grave. If there is an actual backup statement, like as far as that goes there, and then within this case there, the very next slide. Sorry about the slowness here, it's just that the... so the next backup information is the actual bank statement, and that should have been coded as A3, and that A3 should have been cross-referenced back to A2, and that information from A2 will be cross-referenced back to A. A should be cross-referenced back to the financial statement. So in the financial statement, I have cash. Where do I find cash? In A. A could be possibly made up, as you can see, of 5 or 6 accounts. In this case here, only 1. So that's what we call it a lead sheet. It's a grouping of similar accounts that's going to represent the financial statement balance. So we called it a lead sheet there because it's a grouping summary. So when we go to A, back to A there, we list different accounts, but those other accounts have no balances in them. So case in point, if you did have cash on hand, you did have some savings accounts, you did have something from the Bank of Montreal, you did have cash clearance. You may have actually had balances that would change that balance of $41,000. As John says right there, you should add a reference to FS, which is your financial statement. The 3 most critical things on it is the fact that you put the name of the client at the top of the working paper, the year end or the period that you're working on, and what's it about. Obviously, if it's a working paper generator, that would come out as long as you did your file set up properly. At the bottom of the page, which is the next most critical scenario, is who has actually prepared the work and who has reviewed the work. So your level of authority goes from that Mr. PS there prepared this particular work, and it was actually reviewed by, in this case, the CGA.
And in your case, it could be by, you could be both. You can actually prepare it and then review it. And you should indicate it on both.
So the bank statement gets cross-referenced to the bank reconciliation, which gets cross-referenced to the summary sheet or the lead sheet of A. So you see how the file can get layered? And if you have a different account, that would have been A.4. Let's say we had a balance in the Bank of Montreal. We may have had another bank reconciliation, another bank statement, and that would be referred, and that the final balance would be cross-referenced back to A, and A is automatically cross-referenced to the financial statement. So that's your layering of a particular file.
And the other information that you could see on the actual lead sheet is that there was 2 balances in the prior year, so it's only in the current year. And
Gives you
that would be something that I would look into as to what happened with the 24,000 that was there in 09, where there's no balance in 2010. So that I would have already picked that up and said, okay, let me look at that. Let me see what's gone on.
Did we missed it?
If this information is already imported from the client's records, then all I would have to do is drill down and see how that account was
Cleared up.
actually worked down, right? And those balances have to flow through to the financial statements.
So the beauty of a working paper generator, you're reasonably assured that that will happen, but you have to make sure that you satisfy yourself it is. So the next account or the next lead sheet is what we're normally used to is accounts receivable. Again, the name of the client, the year end, what are we talking about, and what represents that balance. So it's always the same format. What number did you start off with, which is primarily the trial balance. What adjustments did I do or not do, and did I do any reclassification to get to an end imbalance? Queries?
Yeah, and pretty good.
So here, the unfortunate part is they haven't spent the time to cross-reference it. So always remember cross-reference. Prepare by, review by. Name of the client, year in, what are you talking about, who did it, who reviewed it. Those are always there. Okay? So the backup to this is the actual age accounts receivable listed.
Okay, so let's take a look at this. We've got $19,300 of total receivables. Predominantly, the biggest balance is current. I don't see anything. I do see a couple of, I see probably about I see about 25% that's greater than 60 days. So you would have to look in terms of where the revenue is at, whether it would warrant you having any further investigation as to, even if you would discuss it with the client, saying, well, what's happening with your receivables? You got 25% of it that's significantly older. Should we do something about that? So you would want to highlight it. So it doesn't take very long to actually get the information and to, start down a path of actually looking at the numbers and making sure that they're reasonable for our purpose. Yes?
We have a question from one of our online participants. And the question is, are notes on the compilation engagement acceptable, or do they indicate more work was done than normal with an NTR, leaving you open to questions about why you did the work but didn't do a review? Actually, she's saying, on lead sheets.
No, now you lost me. You had me all the way up until the end.
Up until the lead sheets?
Up until the lead sheet. Yeah.
Joanna, if you could please clarify, that would be great.
Okay.
Okay.
If the common is your documentation, you got to watch out that the fact is that the documentation you put on any working paper supports the report that you're given. So by adding excessive commentaries, you may show that you may have done excessive analytical review or analysis, which may be a review technique or is not an audit technique. However, you may have to do some of those steps to satisfy yourself that the information may not be false and misleading, but you may have to also come up with an additional commentary of that.
The notes, whether we're working for whatever engagement we're involved in, the notes should be an integral part of the financial statements.
Yeah.
So I'll give you a perfect example. If I was doing a note on inventory for a review engagement, that note would indicate the level of work that I've done on inventory. I would indicate whether or not the inventory value is at the lower of cost or net realizable value, and if it's on a first in, first out basis, I would actually indicate the work that we did to give it plausibility in a review. Okay? On a compilation, the client can estimate their inventory and say, well, my inventory, I've gone through it, is $22,000. If that information is on my financial statements, I would indicate that the inventory is estimated by management. So that would be the note that I would use. And if we have depreciation as an example, we're using capital cost allowance rates, I would indicate that. So the notes would definitely be appropriate to the compilation engagement. Having 3 pages of notes on a compilation doesn't necessarily mean that it's now a review, because I got 3 pages of notes. Yes.
She actually clarified the footnotes on the lead sheets.
The footnotes on lead sheets.
Yeah.
What do you mean about including it?
Yeah, so her original question was, are notes on the compilation engagement acceptable, or do
Yes.
they indicate more work was done than normal
No, but like I said,
with an NTR?
it all depends on what you're trying to do, in theory, analyze or support. As you write more commentaries or more analysis or more queries that were answered, then yes, you may have done a review or an audit technique. However, you may want to end off there, I was forced to do that because I wasn't satisfied with whatever you were questioning. So just go blindly and add on extra notes or extra queries. Yes, that may give you a further indication the whole file is on the lease of review. So you got to watch out about adding additional commentaries within the working papers, and you got to justify them, or you got to make sure you eliminate them. But just to include them once in a while, it doesn't throw you offside. It's hard to say until you see what's in front of you.
Okay.
Quick question.
Hold on, she's got another one.
Sorry,
Oh, go ahead.
I didn't see you.
Go ahead, please.
I guess the participants online can budge you, right?
Fighting.
So one of the questions was, could you please show us how we would cross-reference the bank statement or the AR listing to the lead sheet?
Okay. This one here should have been, in theory, on the bottom right, on the bottom corner, should have been said B.1. If this is B.1, then the balance that you're transferring would be 19,313.92. So you would say to B. Then when you go back to B, which is the lead sheet, the summary, well, you guys are going to make sure I do exercise today. Pretty good for an old guy, right? Okay. So we're saying this is the representation on the financial statement, which in theory we should say over there, FS. In the annotation, we should actually have said B.1. Okay, in the grouping of B, we said it could possibly be made up of 3 accounts, but only one is applicable. As John said, we may satisfy ourselves that the fact is, don't touch the computer.
I know. Sorry.
It's very sensitive. You got to go back up.
Here, you do it. I'm lost.
As I said, this is why when I said preparing corporate tax returns, I said they wanted to do this paperless. And I said, well, you just can't flip around schedules that easily. And this is like another perfect example.
There we go.
Okay? So, in there you would say B.1, and the backup to that would be, in this case here, the age listed. So B1 is the supported documentation behind B. If there was further analysis or information behind that, it would be B2, B3, B4. The bank is probably the better one. If you said with A, A1 should have been the bank reconciliation. A2 was the actual bank statement. We had the second account, it should have been A3. What you should do is make it 1, 2, 3, 4, 5, 6. So when you kind of set up there, all I got is the 6 pages in A and where are they referenced to. So think about it. You got a lead sheet that has an account that could be made up of 1 at the minimum or a whole pile. It could be as many as 20. Those are all grouped together, so they're grouped together, and that's why we call it the lead sheet there. Each one of those subcomponents should we've come from some other information, right? So what we do from an indexing standpoint is the backup to B would be B.1. If I go look at B.1, it's an age accounts receivable listing. So you go from behind to. I'm taking it from behind, so it's B.2, and I'm bringing it forward to B. There, I'm taking it from behind, it should say FS, and it should be brought forward to the financial statement. Because when I do my internal draft statement, it should have been referenced to a Jiffy account, and it also should be referenced to where I find it as far as the lease sheet is concerned. So it would say like for bank, it would say 1,000, and it would say A. So what is it for Jiffy? Where is it in the working paper? And now we're just doing a layer. If we go back to the original index, we're saying in the index, if we look at A, we find bank. We look at B, we find receivables. We look at U, we find fixed assets or capital assets. We go to L, we find prepaid. The reason that we can say it at the top of our head is the fact that we don't change it for any file. So the more uniformity you get, there's no doubt where you're going to find inventory. There's no doubt where you're going to find receivables in any file. And then to find it in that particular file, you find it by the master index. So the index is always annotations behind, and you're carrying it from up and to it. Or in this case here, you're going back from 19,000 Where do you find that information? You find it, in this case, the very next page, which happens to be the age accounts receivable listed.
I think we're good with that.
Okay,
You have a
the next one gives you more of an indication of grouping of accounts. Question?
Yeah, go ahead.
Actually, you answered one, but Bruce, you mentioned FS for financial statements. Isn't
Yes.
the indexing here numbered like 2? I don't know, am I reading the wrong
No, but
thing?
FS is usually standard.
That's
FS
actually the
financial
proper,
statement.
okay,
Yeah.
okay. And I wouldn't reference-
However, whatever you want, if you're consistent, if you want to refer it back to the actual draft
No.
financial statement, if you
Okay.
want to index to 2, there's nothing wrong with that.
Okay.
Okay, it's like just a
And I wouldn't use the term GL that I have here as part of your detailed general work, I guess, kind of a thing? It's just FS is the proper thing?
Well, GL is what we would term is coming from the general ledger.
Okay, all right.
Yeah.
Coming from, right?
All right.
So basically, what you would want to do is, the reason you're indicating FS is your financial statements. When I come to your office and I do a practice inspection, I start off with the financial statements that are indexed. So the first thing that I'll look at is I'll look at your cash in your financial statements, and it'll be indexed to A, or it'll be, your case could be B. And then I'll go to B, and I'll see that those two numbers are the same. Then I'll go one level below to see what did you use to come up with that number. So that's basically what the process is. Your final statements have to be indexed.
If we went back to the bank reconciliation, if you want to confirm there, you can actually put a GL there. But now you could potentially get into a review or an audit technique. The statement was balance per ledger. So the balance per ledger is that. So your reference there would be 2, in this case, A. Okay?
We have another question from one of our online participants.
Okay?
No.
I'll ask it then.
Okay.
Are checklists still used for each lead sheet in compilations?
No.
No. Like, remember I told you, for a compilation, there's a global checklist, not per individual account. Only on the reviews and audits do you have a checklist particular to that particular classification of asset or liability.
And I guess the reason I would say no is because you could create one for yourself, but it's not necessary. A checklist that you would have per section on a review or an audit is because of the detailed number of procedures that you're following to complete that section. On a compilation, we are really only doing a number of different procedures, which are few. So at most, is in the general checklist, there is a section that says, are the balances reasonable? And you would indicate cash, yes. You know, that would probably be the most that you have right now. Okay.
The procedure you do on a compilation is, like every account balances, if you actually go back with the detailed notes that we didn't want to bore you with. Okay, I look at cash. As John said, is it reasonable? If you answer the question yes, you vacate. If you answer the question no, you got to say, why is it no? Why is it not reasonable? And what additional steps do you have to do to satisfy yourself to get it back to a yes? So the more that you can reasonably substantiate it without going to excessive detail, that you're not doing a review or not doing an audit, is more than sufficient on a compilation. So this schedule here, is your first indication of a true indication of a lead sheet or a grouping, where it's grouping a master components of different types of assets. You have office equipment with the accumulated depreciation, the computer equipment with the accumulated depreciation, the furniture with the accumulated amortization, and the automotive with the accumulated. Now, when you kind of do the comparative, if you see 3,000, 3,000, don't have to be a mathematician or a great analysis. The fact is there's no further additions. The only difference between this year and that year should have been the current year's entry for amortization. 21 to 25, little bells and whistles should go off that the fact is I got something there in addition. In our case there, we came up with the addition through an adjusted journal entry that we haven't looked at yet. So maybe something got expense that we're going to have to readjust it back and reclass or set it up, or maybe it came up through accounts payable because I haven't seen the journal entries. But the fact that those are changed should indicate that, let's just say that number was a 25. Then that should twig you to say, hang on, there should be an addition. Right? 18 to 20, your difference should only be the write-off of the other format. Same idea there. Here, nothing, something, carry forward, so you definitely should twig yourself, hey guys, I bought a car, I bought a truck. The annotation should be a reference back to, in this case, the continuity schedule, which should be U1, U2, which is over on the next page. So if you go to the next, hey, I hate this thing. So the first part of it said, okay, let's list the computers, office equipment, furniture, and automotive. What did we buy? A 2010 Dodge pickup. Remember? We had an addition. So logic should dictate that the fact is I should have $44,000 worth of addition. Specifically, I would satisfy myself that that's the exact number. But just by doing the lead sheet, it gave me a little bit of wealth of information without going into any great depth that I had a couple of items. One I may have to adjust for. One was the client brought it to my attention. How I remind myself it because I compared it to last year's financial data. So if this was an assistant client, it's easier. If this is a new client, you got to be aware of to ensure that the data is 100% complete. And if that completed data and you're satisfied that you do have a continuity of fixed asset or capital assets there, that you can pretty well assure yourself that you will have these type of additions. So then the next one, or this is a duplication. The same, okay, what are we doing here? Okay, so a U2 is just actually a reference of the total of the asset side, and the next one, they just broke it up to figure out the amortization. Okay? So I would have done here, I would have said the first page was U, the next one was U1, the next one U2. On most of our examples, we would have those two pages on the one similar page. What we would cross-reference back, and the key is always cross-reference, is we got the balances. So that balance got referred to where? Got back to U. So we should have said to U, to U, to U, to U, or as a combination to U. So we have individual accounts that got grouped together, in this case fixed assets, that are supported by, in here, a continuity schedule that highlights all the additions and all the disposals within that fiscal period. Depending on the nature of the file or your complexity or the fact of your comfort zone there, you may or may not actually have a copy of the fixed asset addition. In case you may have had a copy of the purchase invoice for the truck and a purchase invoice for the computer, but it's not necessary. More so in a compilation. But you may want to do it from a client service standpoint for future disposal.
You might also want to look at the HST or GST implications on the additions and whether or not they were picked up on the client's end. Every time you see new information, you should be aware of the things that trigger off in your head.
Or the other stuff is, how did they pay for it? Did they pay for it by cash or is there a loan?
Well, they might have used cash because remember there was a
$40,000.
$25,000.
You've answered the question.
Yeah.
God, you should be an auditor one day. No, but you see, this is how you build up the information. If you can store it, put it to the side. Like I said, John noticed that how come the cash went down by $40,000? You go through the file. Oh, gee, there happened to be addition of $40,000. It may exactly be the exact reason why, but it makes it reasonable that they're directly related.
That's the key, is that what it does is it's answering itself out, and you're not suspicious or you're not as skeptical, right?
Because you've got to satisfy.
It's very important. You've got to satisfy yourself. Okay, so now we're flipping over to a liability section.
and we have an operating loan. Here, the person put on it, view the online banking account with the client and determine that the balance was correct as presented. So that goes back to that lady or gentleman that was asking the question about doing the note. So I didn't take a photocopy of it, I didn't take a picture of it, but I made a statement. There's nothing wrong with that.
No, nothing at all. If
Okay.
she was actually, if the online person was referring to making
That
this
note.
type of a comment, I wouldn't even call it a note.
Right.
This is basically a comment that as to what the person has done. There's nothing indicating there that she performed a review engagement or an audit engagement. What the person is saying is exactly that the operating loan exists. So
Okay.
it's reasonable, and we can move on.
But the key word, okay, you can argue that she discussed it with the client, but she still had to satisfy herself that the fact that there is a balance outstanding, and it does make sense. So normally you would take a copy of the loan statement.
Yeah.
But by making that comment is more than appropriate,
Yeah.
especially in a compilation, because it just has to be reasonable. Okay? So in that case there would be no backup information because it was supported by that comment, other than this would just be a reference that again it goes to the financial statement. Again, to remind you, name of the client, the year end, what are we talking about, and at the bottom of the page or the bottom of the working paper, there should be at least 2 signatures.
One more.
I get a little scared when I see blank. Lot of space. Come on.
What happened? Come on.
Come
There it
on.
goes.
Come on, little baby. Come on. So as you can see, the reference is AA. It was done by PS, and it got reviewed by CGA. It's very repetitive. Every financial statement item is supported by, in this case, a lead sheet, which may be supported by individual accounts, which may be supported by documentation, commentary, or copies of whatever. Accounts receivable, a bank statement, bank reconciliation. This case here, it could have been a loan statement. Question? Yep.
What would happen if the balance is changed? Like if the client came back and said, oh, made a mistake, the balance was this, and you've already, like, can you basically go and cross out the information on the prepared and reviewed by?
Oh, yeah. Well, don't forget, this is a working paper generator. So don't forget, you can always go back and say that you had additional information and change it. You know, how you pick up that additional information, you may have to do a journal entry.
Right.
Yeah, it would change a lot of things. It wouldn't just change that one schedule, right?
Absolutely, yeah.
Yeah, so you would have to go back and reprint correctly, and you would have a different date as to when you did this, right?
Yeah, because usually, like, when I provide information to the CGA, she usually says, oh, well, give me your first draft statement. And I always preface it and say, well, you know what, I'm not done yet. Yeah, but we want to get started. So,
Right. Okay, but then the adjustments come back to you, right? Once they look at them?
yeah, but, and then she also says to me, any adjustments you have, make sure I get them so that we can stay in sync.
Oh, okay, so you're mutually both working on it at the same time. They're starting,
Essentially, she wants to get started on
Is
the
she doing a
file, and I'm
review?
not totally finished with the trial balance.
okay, is she working on a review or a compilation?
Compilation.
She's working on a compilation. It's a little awkward.
It is.
It is a little awkward
It
because,
is. But it's real, and it happens.
well, it's, when we work with interim information, I've had clients, as an example, fax me their internal records and say, okay, we're going to send these to the bank. Can you take a look at them? And I say no. And the reason I say no is because I'm not doing any work on it, and just taking a look at it and them faxing it to the bank and saying, John's looked at it, it's like I'm a priest and I blessed it. And I don't want to do that.
Right.
So if they want to do that, that's fine. But I don't want to have any involvement unless I'm doing a compilation. So I really have clear lines as to when something starts and when it stops. Because you could kind of run into each other and have and have he did it, I did it, she did it, I did it, and and end up with a problem. She should let you completely finish before she starts.
Right.
That would probably be the better way to do it.
Okay, any others?
Question on my end.
You're not becoming my favorite person.
It's okay. No problem. So the question is automatic indexing in accounting software acceptable without further manual cross-referencing?
The automatic index, there's no such thing as automatic. The only thing that it will do is it will actually place the index at the bottom of the sheet, but you're the one that's actually doing the indexing by going in and putting in where it's coming from, and technically what it's doing is it's just telling you what that's set up. But you could change that. If you want to change liabilities to be BB, it'll change it to BBB. So you're still in control as to what it is.
Your automatic index is what you've set up, like in this case AA or BB. But the annotation, normally you would have to enter it in there. If it is generated, you got to make sure that everything's exactly in the same order, and that would be virtually impossible to do at any time.
Yeah.
Okay, so the next one would be accounts payable. Always reiterate, name of the client, year end, what account are we talking about. These are the possibilities of the account. We started off with $23,000. We didn't do anything reclassify. So where will we find it? So in there, you would put down, for argument's sake, BB1. So if you look at BB1, which is the next page, again, it's going to be an age trial balance. Instead of accounts receivable, it's accounts payable. Now in this one here, hang on, let me do my little speech first. In this one here, you would say this is BB1, so you would say to BB. Now in this particular client, you still have what we call debit balances. But the debit balances may be small, and I hate to use the word at this stage here, immaterial, but we don't have to necessarily adjust it because we still only have to satisfy that the information is reasonable. However, there's nothing wrong to reclassify those potentially as, if they are, accounts receivable. The other thing, if you want to do a little bit of poetic license, is that if you take the last account there, the 384, we find out that the 384 is actually workers' compensation. You may argue, since you have a separate category about payrolls and deduction, you may want to reclassify that against that account. However, again, the individual number is not that large or material, and you're not going to mislead anybody by not reclassifying or transferring it as an entry into payroll and other deductions. So it also kind of shows you do have a little bit of latitude. You do not have to change every number. You do not have to reclassify every number, but you should be aware of it. And all you got to do is every time you list an account or anytime you vacate a group of account, that you satisfy yourself that the amount is, or the representation is reasonable in this case. Now you have a question.
Do you usually do an adjusting entry to accrue the accounting fee for the year end?
Absolutely, as large as possible.
Large as possible. No, but actually, you actually should also, all kidding aside. No, because it is reflective of that period. I mean, we're taking to the Joes that is self-serving because that's the fee that we want to get paid. But if the expense is not there, and it is reflected to that thing, it is by definition an accrual. Yes, ma'am.
On the WCB there, you said I wouldn't change it because it's immaterial, but would you make a notation to say that I've looked at it and I've made the choice not to change it? No. Okay.
I don't know whether you would need to do that as well. I mean, you've looked at it. If for comparative reasons you've got, as he said, you've got a section where you're dealing with payroll and payroll-related items, then you probably would just adjust it, reclassify it to be comparable, right? You would either do one or the other. Either you'd leave it alone or you would make that adjustment. But you wouldn't need to make a note of it to let me know if I was
Did it or
looking at
didn't
it
do
as a practice inspector.
Yeah,
Because I would look at it in the same way. I would say it's $384 and I'm off to the next thing.
Okay, so that was
Yeah.
just my,
Yeah.
that was more my question,
Right.
is that too much work
Um,
on a compilation?
Yeah, it's too much thought process to actually start documenting it.
Okay.
Because you could have actually reclassified it and not have to
If you
document
de-
why you
Exactly,
didn't reclassify it.
If you decide that you have to put a note towards it, I think John answered that, you should reclassify it. Because
Right.
obviously, if it's twiggling on the back of your mind, why say why you didn't do it, just do it.
Right.
Because all it is a
Exactly.
reclassification entry. Okay? Oh, now you're not ready, eh? Oh, sure.
You know what, Bruce, we really don't have to go through all of them if they get the gist.
Well, we don't know. Do they have the gist?
I mean, we could pose it to them and we could go back to the
Are
slides.
you getting the flavor and the feel about
Yeah.
the idea of the working papers and starting to
Are
see
you
it?
good? Yes.
Can we cover the year-end kind of checklist
The actual checklist?
Yeah, when you do the year-end adjustment, do you kind of have a full checklist or?
This is exactly what we've been going through is the year end. We've been going through.
Yeah, you're
each
compiling all the existing entries, but the
No, but when
sometimes
you-
the small businesses, for instance, amortization, these.
We did. He covered advertisation. We went through that.
Yeah, and any particular other areas of things that you
Okay,
might
most,
need to.
most compilation, the same idea what most bookkeepers will not do, and I already said that earlier. They do not do any adjustments for amortization, and they do not any adjustments for tax provision or bonuses. So if you really want to get totally facetious and say the least I would do on any given file, if they have not been done, will at least be those 2 or 3 areas. Okay?
Other than there's no other like big areas.
If the rest of the numbers as is are presented and supported in your mind that they're reasonable. You're not obligated to make any other more adjustment, and you don't have to come up with a materiality to say, okay, this is immaterial or material. So, I mean, we say that in our minds always, because we say, I would not make an adjustment for 384 because I'm not going to, the better way of saying I'm not going to mislead anybody, which is the basis behind whether or not I said the item was material or immaterial.
What would the sales be of a small company that you're talking about?
1 or 2 million sales.
Okay.
Very small.
See, okay, 1 or 2 million to most people in the room here would not be small. Okay,
but,
so see, I get where you're going at. You've got to be careful. In terms of the amount of work or the lack of the amount of work that you're prepared to do on a file could get you into a lot of trouble. So, and that's why I posed that question, because I'm sure a lot of other people might have said 20 or 30,000 was small in the revenue, but you said 1 or 2 million. So 1 or 2 million for us would be a decent file and a decent revenue for us and a decent compilation. It would definitely not be. In terms of all of the other things that come together with the file, right? Or with the client, sorry.
Another question actually. We're compiling all these statements with all the lead sheet and all supporting documents.
Yeah.
But at this level, I don't see actual outside source document, which is more
May not be
objective.
warranted.
Yeah.
Well, there was an outside source
He
document
says
with
many.
the bank statement.
So basically, I don't see.
Are you trying to ask the question, why are we even doing lead sheets?
That's right.
Okay, you're asking the question, what's the least I can do that I can get away with not doing anything else? And
I think we're going to have a hard time helping you.
That's right.
So just in case CRA.
Okay, but remember, this
for
is done by a
audit,
program. It's not costing you 1 ounce of extra effort for that information to come out, and it is reflective. It seems a little bit excessive because a lot of the accounts only have 1 account per lead sheet. So yes, you could do a direct reference from the trial balance right to the financial statement. The only grouping that you pretty well had there, if you looked at it, was primary to fixed assets, and you can argue that was grouped differently. Each file stands on its own, but if you attack every file the same way, and it hasn't cost you any extra effort to do it any same way, regardless whether or not there's one account or 20 accounts that are grouped together, then you don't have to really think about it. If you're doing it manually, then maybe you can argue that the fact is, why would I do a separate lead sheet on it when I have the bank reconciliation? I referred it back to the trial balance, and the trial balance went directly to the financial statement. So yes, you can take a short or a cut there, but we're also taking the assumption that this is done by a working paper generator.
Okay.
Okay?
Thanks.
Just one final question. Are you the bookkeeper? Are you the bookkeeper? Okay, so when you do the bookkeeping, as far as you're concerned, you're finished. When you've got your bookkeeping done, right? Are you producing financial statements?
I compiled too, and reviewed by other,
Okay, if it's reviewed by another accountant, then you don't have a file. You don't have an engagement. What you're doing is you're actually providing a complete set of books for another accountant. Whatever schedules you may be providing, you're just providing them just as if you were the controller of that company. The other accountant is saying, give me this or give me a copy of that, and the other accountant is the one that's got the file. We're trying to teach you how to, you have the file, not the other guy.
Okay, so look, all that person did in this particular file or sample was 4 entries. One to amortize, one to correct an error, and the tax revision. This one here, remember, I didn't even look at the file, and I said probably what it is. So what did they do? Debit computer expense, credit supplies. Because maybe when they looked at last year's supply and this year's supply, or they had access to the detailed GL, they realized that there was actually an addition that would quantify as a capital asset. So what did they do? They made an adjusted entry. Not a reclassification, an actual adjustment. Because they pulled it out of supplies, put it into asset. Or they took it out of expense and they put it into an asset.
Yes.
Just going back to the previous schedule on this property, plant and equipment.
Yes.
There are some information here like additions and the amortization charges. Can
Yes.
the working paper program generate the amortization charge as well, or it is just an example?
Yes.
Oh, yeah.
Can it do that?
Oh, yeah.
Yeah.
Okay.
Once you set in the rate.
Okay.
If you show a new addition, you said the rate is 30%, it will calculate for
And
that.
prepare this reconciliation
Yep.
schedule as well.
It'll even take in the half-year rule into consideration. If you tell
Oh,
the
really?
half-year rule is applicable, it'll do all that. What it won't do is do the journal entry for you.
Okay.
You'll still have to book the journal entry.
But
Thanks.
what it will do is compare net book value with what you have in your working papers to remind you that you have not done something
Yeah.
doesn't balance. Your lead sheet doesn't agree to your
Yeah.
support and paper, which is usually the adjusted entry. We had a question up here?
More of a statement like you're talking about this $4,000 that they found. I've worked in manufacturing a long time. One of the standard questions you always get is provide me with the repair and maintenance account, the detail, repair and maintenance and supplies. And they just go through and they look at it and they pick out the big numbers, and it's either capital or it's a realistic expense.
It's real easy, right?
Yeah.
Agreed. So what they do, they question it, right?
Yeah. Good.
Because, don't forget, remember, like I said, when I worked for CRA, what's the first thing I would do? Look at repairs and maintenance and supplies to see if things should have been reclassification, like at that stage there. So your external accountant, whoever he, she, or they are doing the same job there. Now, the other argument, because it's computers, like as far as that goes, and in the year that it's bought, they may have tried to argue that if that did qualify for that particular year of the 100% write-off, that's why I expensed it. So technically, if you did expensed it, and it was eligible for 100% write-off, it's in the same port, but it still is better to reclassify it as a capital asset, amortize it at 100%, and then that alleviates the doubt. And then you could have supplies, for argument's sake, could say 4,000 last year, this year 8,000, then go back to next year's 4,000, and you got that little hiccup. Why did you have that hiccup? Like as far as that goes there. So it's probably better to pull it out even if it is subject. What you may not make an adjustment for is, like I always give the example, if I do corporate tax return, will you buy one chair costs you $150. If you expensed it, more than likely we'll leave it there arguing that what it is. But if you bought all the chairs here, 30 of them, even though individually they're they're not expensive, but as a group, they should be classified and reclassified as a capital asset. Your bigger question is, where does my repairs and maintenance stop, and when does my capital acquisition or capital improvement start? So what is an operating expense and what is a capital expense? Also, because don't forget, you could be spending $10,000 on renovating something, and that should have been capitalized as opposed to expense, because it may argue that they have a long-term nature. But that's for maybe you to satisfy, it could be an accounting issue, or just simply to satisfy that whether or not there's a tax issue involved, which again may get you back to an accounting issue.
We have a question online.
I knew if I leave you long enough.
Here's the question. Should you not note in the adjusting entries the working papers to which the entries apply, or the entry applies to?
You can.
There's nothing wrong with it.
More annotation or documentation in that instance doesn't hurt as to where it's coming from. Sure, that's
It all depends what
It's
type of working
acceptable.
papers you're doing. I mean, since this is a working paper generator, once you did the journal entry, it affected those accounts. Remember, we started off every account that says preliminary, adjustment, reclassification, representation. So your cross-reference, in theory, would go back to, and then don't forget, like remember, when you have the program in front of you, like John said, you can drive down. So you went in, if you went in for argument's sake for amortization of equipment, and we went into 1310, if you would have clicked on it and then drive down, it would actually refer you back to that journal entry. So the cross-reference is actually inferred by the drivability of that particular program. Manually, again, you should cover yourself, because if you looked at the individual working papers, you said you started off with a GL balance and you've adjusted it. And usually we get a reference to which journal entry that you adjusted to. And this is just a summary of all your journal entries, which are transported to each individual lead sheet, which is transported to the actual trial balance, which eventually gets to the financial statements that if all you got is this small, simple account, you could vacate the actual lead sheet approach more specifically on a compilation, because the only thing on that lead sheet is exactly what it is, a grouping of accounts. Where you get into a review or to an audit there, other reason that you do the lead sheet is because usually the underlying programs or questionnaire or checklist is usually right below that or adjacent to it. Okay?
Okay.
I guess you were talking about amortization, and if the company has a policy of, let's say, every single item below 2,000, we just expense it. Would that be acceptable to you?
That would be the company's materiality as an example.
Okay, yeah.
There's two facts. If we're involved with the tax return, we would have to look at it in terms of whether that would have to be adjusted for tax purpose. For compilation, that might be reasonable. You'd have to look at all the other numbers.
So as long as they made a business decision that makes sense to them for the use of whatever it is they have.
Your company made a decision. It's up to the external accountant to agree that that policy is appropriate for whatever reason. So if they believe that 2,000 is too liberal, they say, no, I can only be happy with anything under 500. Supplemented by the fact is, as long as that's a group of amounts of under 500, do not group together that there may be a material adjustment. As I say, if I buy 1 chair, 2 chairs, 3 chairs, individually, if I looked at them in 3 different months, no big deal. But all of a sudden you bought 10 chairs throughout the whole year, now you got something that potentially may be material 1,500.
That's what I was saying. You got to look at the numbers. If it's infrequent, and and that's how it relates to the other numbers, then it's going to show up. So at the end of the year, you would have to look at that, right? You'd have to look at
reclassify
we would reclassify. Like I said, there's tax implications above and beyond the reasonableness for financial statement purpose, right? You got to deal with both.
Thank you.
You got to satisfy. I got a better question for you. What's your definition of casual labor? $500 of what?
Something not connected with the ordinary business.
So I pay a person $200. How often can I pay that person and still be casual? So remember, casual labor is by a pure definition as it stands alone there. If I paid one person once, maybe twice, then that, and the amount's small, it may be a casual labor. If I pay a person a small amount but on a very regular basis, that person may be a part-time employee. Therefore, you have to issue a T4 and take taxes off from sources or whatever. So again, you got to look at things from an individual one-time transaction standpoint, but you also got to use it as accumulation. I had a client there to charge it off to, what do you charge off? He charged off drivers at casual wages. Never even looked at it. The amount was really small globally relative to the client because it was about $3 million in sales. The auditor comes in there and he says, I got a problem with this account. I said, well, what's the problem with the account? So when I looked at it, I saw $400 a week paid to cash every week. So now I had $20,400 paid to cash, and every one of those checks got signed by the same person. Okay, what was that person before? Before, that person was a driver who was on the T4. He turned 65, so they let him off. But he wanted to get paid. Didn't want to affect his old age security can and pension, so he got paid cash. I said, you got to be a complete idiot. I said, not only are you paying the same person all the same time there, you pay the cashier. I said, don't you think people actually look at the check to see who signs it? And that's the first thing they did. So like I said, the more often you do something, you have to address that issue, whatever that may be. So your $2,000, if it only happens once throughout the whole year, relative to the total sales, to the total expenses, may be more than appropriate. But if your $2,000 are happening multiple, even though different categories, as a group, they may be material. The same idea with casual labor. Question?
Okay, to add just the casual labor argument, sometimes with my payroll experience, it'd be more prudent for just an employer just to, if you're going to pay someone casually, just to pay them as regular wages and deduct the appropriate statutory deductions. So therefore,
you solve your issue.
You come clean and just have nothing to worry about any potential
That's
audit
right.
that comes through. But my other question I want to ask is, I don't know if you're going to touch on adjustment number 4, but why would corporate taxes payable be debited in this case and income taxes current be credited? Is this here a recovery or something? Or did this
Well, we haven't seen the statement.
Yes,
it
it
could
was
be a recovery. It could
No.
actually be installments that have been paid.
No.
And you're actually reducing the
No, look
liability.
at no, I saw that. The statements are in the loss.
So then
Look
this is,
at the financial
Well,
statement.
it actually says right there, too, net loss, 31,000.
That's right. So it is a recovery.
Yeah.
You have to be observant beyond the factor. Look back at the forest, not the trees. Right on the bottom, it tells you that the cumulative total is a net loss, which you accepted that, yes, that is a recovery of income taxes, because what can I do with losses? Carry them back for 3 years. Anything else? Boy, I woke you guys up, eh?
Okay, if a client bring a bag of document at the end of the year and you do the bookkeeping and the compilation,
Yes.
who is responsible to keep document, you or the client?
Who do the records
What
belong
documents?
to? Hold on a second. Who are the records belong to?
Client.
Well, the records have to go back to the client. So the only time you've got to keep the receipts, if you're an e-filer, you've got to keep the original receipts for the return that you've e-filed, because CRA is requiring you to hold on to that if you've been authorized to file that return electronically. But the records go back to the client, right?
So don't forget, you may be confused in what you may keep copies in your files, but the copies are copies, not the original documentation.
Yeah.
You would take a copy of the fixed asset addition. You would take a copy of the bank loan. You would take a copy of this. But the original record should always go back to the client. And that's the other thing, just from a practice standpoint. Don't forget, the client's bringing all your records there. Don't forget to package it up and bring it back to them. Otherwise, you become the storage capacity of all your clients for all their records. It gets a little cumbersome after a couple of years, especially when you got a lot of clients. Okay, so we try to take a walkthrough of a file so you understand the process of layering You can, yes, you can simply layer without a lead sheet if all the files are single account, whatever. So the lead sheet, if you do it on every file, especially if you're using a work and paper generator, you don't have to think about it. Should I include it or should not include it? All it is an extra piece of paper coming printing out there, and it's a safety net. What if you actually do have 2 or 3 or 4 accounts? Watch out your words about small clients and materiality in your mind. A small client is a client under $30,000 or $40,000 with very little activity. You start getting above that there, they could have a lot of stuff there. On the other thing, never ever get excited about or depressed about is the fact of gross revenue. What's the point of having a gross revenue of $50,000 or a gross revenue of $50 million if you have a direct expenses of $45 million and $5 million that is the labor? In both cases, you may find out the net income for both of those 2 companies could be $100,000. So like in other words, you got to look at the comparable, what is my revenues relative to my cost to give me a GP, to give me my expenses, to satisfy yourself to whatever it is there. So like at that point there. At the larger the amount of gross revenue there, then in theory, potentially the higher the level of the engagement that may be transpired. But I've done clients for $7 or $8 million and still done it on a compilation because they have no finances, no other format there, and they're quite satisfied with just doing a simple format with it, and there's nothing wrong with it. I'm not obligated to do a review, and I'm not obligated to do an audit if it's not necessary. What I'm usually obligated to do is what the external users are dictating to that particular client of what they're looking for or perceiving. What you got to look at it from an accounting standpoint is the fact is, talk to your client and say, what did they intended to do, mentioning in a couple of years. If the client is intending to, in theory, want to sell his business, then it's probably better that you do that statement on a review basis, because that adds more credibility to the statement for the potential buyer to look at it to say, how am I assured that those numbers are properly reflected in the information? And that's why we add the word assurance. So if it's not an absolute requirement there may be external forces that may require it, or a down the road scenario. So if the guy really wants to bail out in 2 or 3 years, you may say, look, we better elevate this to a review because it'll make it easier that when you do put it up for sale, that the person will be looking at the number and we don't have to go back and or have to do a little bit of extra work, like from that standpoint. So there's a lot of different reasons why a file may change, not just necessarily by external purposes. Anything else?
I think we're pretty good. If there's no more questions, we can go back to the slides.
Let's go back to the slides.
And no online
Can we go back to the slides, Ellie? Now we just got to find them.
Okay.
Was that useful to you or helpful?
Good.
Okay, good. Which one? This one.
There we go.
Okay. Slideshow. Ooh.
You went right to the beginning.
No, but I want to expand it.
Yeah, it's okay.
Because this one's easier to get down on.
Yeah. Good. Yes.
I think we stopped there. Yeah, because that's where we stopped.
Yeah.
Okay, so now we go back to the slides, which will be on overhead 314. Now we've probably maybe talked about it, and now if you can actually go back to the individual like working papers, it may help you. So balance sheet, account working papers. All balance sheets accounts are actually looked at, reviewed, no, I shouldn't say reviewed, touched upon and showed. Showed a year-to-year changes in the account balance. That's the other advantage of the lead sheet. Because remember, as John said, I had a bank balance there last year, and I don't have a bank balance. I wonder why. So he puts that at the back of the head. He doesn't get too excited right away there. So let me see how things transpire. Then when he got down to the capital assets, he sees that there's a fixed asset addition of $40,000. Well, gee, I got $40,000 less in my bank. I got a new asset of $40,000. They may or may not be truly related, but at least gives a reasonable explanation. Reasonable explanation why something has changed. And all you have to satisfy yourself is, it makes sense. Is it reasonable? You go up to a review, is it plausible? If you go up to an audit, you're attesting to. You're adding more credibility to that information.
And the last is balance flow to lead sheets and financial statements. And we've really covered that fairly extensively today, this afternoon, in terms of actually visually showing you as opposed to just saying it.
Processing transactions and adjustments, year-to-date numbers to work and trial balance, normal adjustment, reclassification, statement of cash flow entries, and closing entries. So these are the type of adjustments that you would do. You always starts with the client's records, which would be the original detailed GL, which is supported by the original trial balance. All bookkeeping services normally ends at the trial balance. It's up to the accountant, external, to probably do it. Now, it's quite possible that if the client already did do the year-end entry, like as far as amortization is concerned, that maybe the only entry they have to do is an income tax revision. But most bookkeepers would not even attempt to attract that. So now you got a trial balance. Are you going to massage it? Are you going to actually make an adjustment? Or are you just going to simply reclassify to keep financial statement presentation clear and concise? Are you going to do entries that just for your cash flow there? But again, if you're doing a compilation, you may not be required to include a cash flow statement. And are you doing any closing entry? Well, now that we're getting into more modern times, usually accountants don't have to worry about closing entries because all accounting packages will close out the prior years. But if you had to do it the old way, John, we're saying the old way. We have to do the old way, back when Mr. Fred Flintstone was alive. You have to actually clear out every account of the revenues and expenses to what? Retained earnings. Because what's retained?
First income summary, Bruce.
Huh?
Income summary, then income summary to retained earnings.
Let's not get too classical. We'll lose them. And retained earnings, by definition, is? Okay. Or net income minus taxes, minus or plus any other adjustment, or potentially dividends, which is a extraction of prior years or current years cumulative net income after taxes. Got to watch out. I'm getting into my tax part as opposed to just simply the other stuff. Good working papers. Information trail. Do you understand the concept of cradle to grave? What's a cradle?
You're not getting a lot of participation.
Boy, I don't know. Cradle, from birth, from start. To grave, you died, to end. From start to finish. If I start in the middle, I should be able to go forward, or I should be able to go backwards. If we take the concept of a working paper, where John talked about driving down, if I actually went to the so-called account, took it to the lead sheet, drove down, figure out what the journal entry, drove on that, find out the actual journal entry, drove down to that to find the actual general ledger account, drove down to that to find out whatever it came from, an invoice, a sales invoice, or whatever, from wherever it started from to wherever it ended up with. As you go up the ladder about external reporting, you may have to document or satisfy yourself that things are fully completed and whatever. So you have to do more detail. But the concept is always the same. Bookkeeping is a accumulation of a summary of data put together. However, it's like a slap-together potential approach. So the whole idea of an external accountant is to review it, to look at it, to massage it, to reflect it in a proper, good form presentation that another person of same ilk or whatever better can come up with the same conclusion that that individual has come up with to compile it. Right? And your job is not to satisfy the client, it's to satisfy the external user. And that's why you may have conflict between the client and you, because your ultimate obligation is to satisfy the end user because you cannot mislead them or misinform them under any engagement.
So basically, just to jump in here, what we have is these slides are actually regurgitating some of the stuff that we've already gone through, but we will go through them again, just to emphasize and give you a little bit more depth as to what's expected of you. The next part where it says clear, concise, supporting worksheets and documentation, it's very important that the file stands on its own. It's not something that, I mean, I've seen files where every sheet in the file is loose. I've asked practitioners, where's the bank reconciliation? It's at the client's office. You know, there's all sorts of stuff. It's your file. You've got to put it together, and it should stand alone with the index, with all the supporting documentations, the engagement letter, rep letter, audit waiver, financial statements, draft statements, trial balance, and all those things.
Where's the mic?
Get the mic. Sorry. I got it.
We're going to dock your pay. You're not doing your work.
There we go.
Even though you have all these neat tools, caseware and stuff like that, do you still print off your file? Is your file a big hard copy binder?
What we talked about yesterday, and what we mentioned debate, whether or not you decide you're going to go paperless or not. But before you go paperless, you got to make sure you have all your checks and balances and security and proper backup. The whole idea that if you produce it here, as you notice me trying to flip through to try to get to the stuff there, it may be a little easier to flip through a couple of pages to retrieve the data as opposed to trying to drive down or flip around or whatever the case may be, depending on how the file's put together. But, you know, like I said, yes. But like, you know.
You're asking us if we do it, we do it. Yeah. We print out the whole file. When I meet with the client and when Bruce meets with the client or anyone else, we have the whole file. We actually even have a folder where we have the financial statements, tax return, all of that information. We meet with the clients, all the letters are there, we review the statements, the file is there to answer any specific questions that we might have, and everything's signed.
And every piece that you have there is in your caseware file as well.
Yeah, everything. So our caseware file and our hard copy file, we haven't moved into paperless. We will.
Will you?
We will. And the problem is that you've got to be pretty clear to make sure, one, that you don't lose that data, because if that's the only file you have and you go to retrieve it and you can't retrieve it, you've got a problem. Secondly, from practice inspection and from proper documentation and all that stuff, that file can't be changed. So you've got to have either a section where it's like a filing cabinet, where once the file is finished, it's printed to PDF, and that's your file. Because the actual working paper file, by opening it, it could accidentally be changed. You know, you can lock it down. So there's so many different ways to approach it. Until we actually decide what we're going to do, we only have the file backed up, but we still revolve around the hard copy. Okay?
You got to remember, we're old people, so, you know.
No,
so.
you know what? I don't know. Hard copies are, everybody talks about the paperless society. I just don't think it's going to come.
You know what? That's your new generation. So the problem is, sometimes
one of the participants in the class in the last couple of days is a licensed public accountant. He says he's paperless in his office. So, any other questions?
There's nothing wrong with it. It's just the newness of the technology that people got to convince themselves that they're comfortable that they have a paperless society. My only reverse negativity, if I go to a client and all I got is 2 or 3 copies of the financial statements and all I got is a tax return and I give them a bill for $8,000, I probably in my mind and probably in reality I know I'm going to get questioned on that. Where if I bring in a file, a copy of the the other stuff there, it looks like a little bit of volume. Like as far as that, so he's not focusing that there's only 10 pages that he's charging $8,000 for. So we kind of avoid that little stuff. Maybe it's just like the old-fashioned accountants, like in the terminology. But going paperless, yes, that is modern. Just make sure they have all the checks and balances and the security externally and internally that those files cannot be altered because they can be extracted to satisfy external reviews, like as far as that goes. And besides, what if somebody has a question, like a bank or another, or somebody else, a lender, you know, how you want to make sure that that data is retrievable and is easy to flow through, like as far as that goes there. If it's very cumbersome, like I was trying to go through the other one, it'll drive you nuts to try to get down to trying to get down to AA when it's on a PDF and it's frozen that way. If it's a live file that you can simply, click here, click there, sure, then do the other format there. So it's not an absolute way that you can say that you can do it, but yes, in today's society, more so. I mean, your kids do 10 times, 100 times more things than what you and I do. Why? A, they're fearless and they're used to it. Like, I don't know if I really want to touch that button. Well, let's touch that button, see what happens. Right? Different.
Exactly.
Okay, so clear, concise support and worksheet and documentation, which I tried to reiterate a few times. Checklist indicating the work was performed, and a compilation is usually done in a global basis in one location. Confirmation if they're applicable. We do this cradle to grave, but we always want to take balance sheets agreed from the GL to the issue financial statement, because whatever we went out the door, we want to know where it came from. Right back to the original, if all need be, to the original source document. Accounts grouping, which is lead sheets approach. So obviously if you have any more than a grouping account is always nice. Knowledge of the client documented to the appropriate extent at the type. So in other words, don't forget also to talk to the client, find out what they have changed or different change or what they're anticipating changes, like as far as that goes there, which may, when you actually start working on the file, it's not going to surprise you. It's not going to beg you to have a whole pile of questions. No point going through 3/4 of the file and realize, I'm missing a lot of data here. Maybe you had a conversation to start off with the person there, some of that information would have came up. Planning and supervision documented. So the planning and the supervision is more so as you get more complicated or more file. The planning format, if you start getting into reviews and audits, you're supposed to plan your approach towards that particular engagement and who's going to supervise it, when, how, and where.
I just to jump in again. I did a practice inspection of a CGA that had an extensive planning and supervision documented on compilation. And you could see that it's something that he carried from year to year in terms of the things that were done and the things, who would do what. And so it's a tool. It's something that you need to do it. Not so much that you need to show us that you've done it, but that it benefits you in planning and looking at the dates and looking at the staff that you have and who will do what. And at the end, obviously, problems that you've come up with, you should either be communicating with the client as you go along or communicate with the client at the end of the engagement that, things that require change or things that require improvements and whatever.
Remember what I said yesterday? If you quoted a file that was only going to be $1,200, you already started a file, and now you see you get a lot of problems, especially the client. The other reason that you want to communicate earlier and sooner is to say, hey, I can't do this for $1,200. I can only do it for $2,500 because I've already put $1,200, and I still haven't touched this, this, and this, nor have I resolved what I came across. So you want to do it as soon as possible, especially if it affects the processing of the file.
Okay.
So I don't think we have to talk. We said, what is a compilation of planning issues and procedures?
No,
We've done that.
We can move ahead.
So bookkeeping should be completed before the commencement of the compilation. I'll go the other way. All you want to do is take it from the trial balance onwards. And usually by the definition of the trial balance, all the other basic stuff is done. All the banks have been posted. Like all the sales have been posted. All the payables have been set up. To the best of the system. So in other words, you're starting from that standpoint. So technically you finished the bookkeeper. If you did have an external bookkeeper, that's where he, she, or they would stop and give you the file from that point onwards. And that should be your starting point. So when we look at the working paper, we say preliminary. Our preliminary is the original number that came off on the trial balance that we gave on the client's record. The other thing you got to tell your clients, stop posting any more activity in that year end. Because you got to make sure that they stop as of whatever the date is, so your trial balance and their trial balance are exactly the same. So when you make adjustments and they go back and post the adjustment into their records, then their adjusted balance becomes your adjusted balance, and those two adjusted balance agrees to the financial statement which has been presented to them. If they keep on changing the numbers, you're like a dog trying to catch his tail.
Or you'll find the problem when you're starting off next year. You won't necessarily come up with a problem when you're finishing this year, but the next year your closing numbers and their opening numbers are different. Even within our office where we have staff and the bookkeeping is done internally, there is a clear point where we stop the bookkeeping and start the file. So we don't go farther because we're doing the bookkeeping. And so we do it a different process. The process is always the same. Once all of the records have been written up and the reconciliations is done, the information is imported into Caseware, and then the year-end procedures start at that point in time. All of the adjusting entries that deal with the compilation engagement is started from cash, receivables, and on.
Okay, so you got it in the system file, you bring it forward, and you start in the next year. And as your first comfort zone, what would you check? Open and retained earnings. Because why?
And retained earnings was there.
Very good. Why? Because in theory, if the accounts got closed properly, all the revenues and all the expenses got compressed, compiled, and that information, positive or negative, got transferred to retained earnings. And if that was the only activity in retained earnings, you should have been the previous year's retained earnings plus the current year's net activity to get to the final retained earnings, which will obviously be your opening retained earnings in the current year. So before you start anything, especially the smaller file, take a quick peek at the retained earnings and make sure that the opening balance. 9 times out of 10, especially if you've got smaller clients, the one thing that they never done was post your year-end entries from the previous year. Not a big error, but something easy to correct. All you got to do is to summarize what we had before, the 4 entries, put them into one entry, post them, and that's your opening entry to adjust the original trial balance, that now you can satisfy yourself the last year's trial balance is your starting trial balance because you've reconciled the major account. Otherwise, you're going to have a big heartburn when you get halfway through the file and but I thought I had $50,000 in my fixed asset there, and now I only got $20,000, but what happened there? They must have sold it. Well, no, they forgot to put the $30,000 addition because they never posted your one journal entry. So your retained earnings should be out by $30,000.
When you're actually going through the checklist, you'll find that there is a question specifically about your opening numbers. And so rather than just ticking it, yes, I've done it, you're either going to have financial statements that don't agree if they go out the door, or you're going to find out as you go through each account that something is wrong with the opening numbers. Because although the retained earnings is an indicator that some other transactions have gone through, but there are other accounts that could be off as well.
So in your financial statement, hopefully, they add up, they are correct. Is there any reason for you to believe that the statements are false or misleading? This is where you got to stop and look at the forest and satisfy yourself, even though it's a compilation, you cannot let that information go out if you got any inkling that it doesn't seem to be reasonable, doesn't make any sense. You may have to do whatever additional procedure to satisfy yourself, even up to the point that you can't satisfy yourself, and you may have to vacate the engagement because you cannot associate yourself with false or misleading information. So you just can't simply take a trial balance, do absolutely nothing, plunk it together without any type of concept and say that everything's reasonable. Like John said, you tell me how to do it, we'll start doing that tomorrow. Because you got to do a little bit of extra work to satisfy. As things start falling into place, like a jigsaw puzzle, like a pyramid being built up there, things may say, We came up with the two commentaries. First commentary, he said, cash went down by $40,000. We came over to the fixed assets, and we said, oh, there's a $40,000 addition. I made a comment that they made an adjustment entry of $4,000, which means that they implied that they probably pulled it out of an expense. I go back to the journal entry, and that's exactly what they did. I had an inkling. I satisfied that inkling by actually seeing something external. So now it appears to be reasonable. If the answer is no, then you vacate. No further procedure. If it's reasonable, doesn't appear to be false or misleading, you've satisfied yourself, move on. Request additional revised information for any of it obviously incorrect, incomplete. So this is your catch-all. If you look in section 9200, there is a paragraph in there that specifically says that you cannot do anything that's false or misleading, which implies that you may have to do additional work even though it is a compilation. The problem is if you do too much additional work in all the areas throughout the whole file, you may have elevated that file to be a review or an audit, even though you've only said, as far as the report is, that is a compilation. And that's the hardest line not to cross over. You want to satisfy yourself all the stuff there, so that's why the lady or the gentleman asked on the phone, if I put comments on my lead sheet there, would that imply that I've done a review? Depends on what comments you put on there. If you put a lot of comments on there, you put a lot of analysis on it, you've done a lot of reviews on there, then more than likely you've done a review file as opposed to a compilation file. And if something goes wrong with that file, you can be sued in the sense that the fact is that things that went wrong there, and you've done above and beyond what you should have done there, so you should have caught that there, so I'm holding you personally responsible, and I'm charging you with gross negligence. And I'm suing you to get my money that I lost. And what you're doing is, as I said, there's no percentage of you being a javelin catcher. There's nothing that we're doing that we've got to die from. We will make errors, we will make mistakes, we will miss things. But we can't do anything flagrantly or without having due care. Sounds like the preacher, right?
Yeah. What a quiet group.
What a quiet group.
Whoa.
We had you awake. We better go back to work. We better go back to files. You know, like they got a little bit more active then. Okay, example compilation engagement. Statements presented financial position, results of operation, and cash flow. You can do interim statements, income statements of a company division, year-end statements, limited use, filed with or reference to a tax return, personal statements, future-oriented financial information. In other words, you're kind of doing like forecasts. Okay? So these are examples of compilation. So in other words, if you are doing a review, if you are doing an audit, but you have to issue interim statements for whatever time period, you can do those on a compilation basis.
Well, what other basis would you do it?
But,
Either review or audit. I think it's just basically telling you that in these engagements, you would be doing a compilation engagement as opposed to just issuing statements on an interim basis and not having a file. You're associating with, I get the example I gave before, the client sending me a copy of their Simply Accounting balance sheet and income statement, and they said, take a look and I'll fax them to the bank. And I said, no, I won't take a look. And if you want to fax them to the bank, don't tell them that you faxed them to me, because I have to actually go through a process to be able to establish. I either do a compilation, a review, or engagement. I can't just look at them, look at the numbers. So that's what this is telling you. Interim statements are going to go out on a compilation basis. You're dealing with divisions, and that was your question on different divisions. I wanted to ascertain what the client needed. What are you doing with the client? How are the records? And then you're going to determine what kind of approach you're going to take. Normal year-end, personal statements. You don't just want to put something together and hand it out. You future-oriented financial statements. If the client didn't need you to put it together, they wouldn't pay you to put it together. So you might as well do a proper engagement and have the statements and properly sign them, and there's a specific report that gets attached to future-oriented financial statements.
And remember, as we tried to say earlier, the fact is, if you got an accounting package that is issuing a balance sheet income statement, even on a monthly basis, you are associating yourself with that data. So you still are obligated at least to do a compilation file basis that satisfies that before you attach yourself to it, or infer that you attach yourself to it, as John says, you know, you need to know to satisfy that those numbers are reasonable in the circumstances. Yes, sir. Hang on.
Where? Oh, okay.
Okay, if you decide to refuse the file because of the misleading information, what should you do? You should send a written document to them, or because you already signed the engagement letter, what should we do after that?
If you decide that you're going to refuse the engagement,
Yeah.
you just tell the client, say, I unfortunately can't take on this engagement, and give them the records
I
back.
can't take on or I can't continue. Return the records. You can cover by letter. Say, look, I'm withdrawing my service from this engagement. I disassociate myself.
You have to be careful on why you're disassociating and what you've seen, because there could be legal issues, and if you're wrong, then so it really depends. We had a compilation engagement way back when first year the client comes in. I know he's in business, but he didn't provide us with statements from another firm or whatever. So I said, okay, I'll take a look at it, but I need a retainer. So we got a retainer. We're working on it. I need more information, but in order to work on that information, we need a little bit more money. He gave me more money. We worked on it, and I kept escalating it, but never got to a point where I could issue anything. So he just got tired of giving me money, and he left. That was it. But it's not that I really just wanted to take fees from him and not do the work. It's just that every time we got to another level, we needed more information. And so because we weren't comfortable with that information, we never got to a point of actually issuing the compilation. So and that's just part of the business. But you know what? It's probably only happened a couple of times in, I guess, almost 30 years. So it doesn't happen that often.
Okay, so again, we go back with the planning issue, which you can basically go back on any type of file, but not as important on a compilation. You still got to make up your mind, are you going to accept or are you going to retain that particular client? Always ask yourself or address yourself, are you independent with that client? Is the appropriateness of the compilation engagement, is that necessary? Remember, as I said, if the client says to you, look, I want to do statements, but in next year or this year I want to sell the company, you may have to educate them that they want to elevate the statement to add more credibility. The other stuff is you got to make sure that the fact is if the person is borrowing any money or lending any money or whatever, you got to check whatever the agreements to make sure that you're not breaking covenants with that particular banking institution. So in other words, they may say, look, I need a review engagement, I need it within 45 days. So it tells you two things, the type of engagement they're looking for and the time frame that they're looking for. Once you have all those factors, then you issue your engagement letter. You sign the waiver of audits or the annual report. What expertise or proficiency do you have to make sure that you can do it in that particular file? And have your time and budget fee. Because more likely, 9 times out of 10, if not 99 out of 100, you should, and they probably will ask, what are my fees going to be for this year? Obviously, with an ongoing client, that becomes less of an issue unless every year your fees go up there and they say, hey, Bob, I love you, but every time I come back, it keeps on getting more expensive. And they say, well, of course, Bob, but we had this problem, you are growing, there's just more involved. So you may have to you always have to justify, but you would have to explain why your fees are going up. Not just because it's 1 year later. There are valid reasons why they are going up.
The most important thing is that it's a relationship that you're establishing between you and the client. it has to be fair. If it's not fair for you, you're not going to be a happy person doing this work for very little. And if it's not fair for the client, they're going to be looking for someone else. So you've got to come up with an arrangement where you can effectively do the work, the client is happy, and you're happy. So it's very, very
Remember, a
important.
long-term arrangement. One back there, Joe?
And we'll take a break after.
Yeah.
Who? Oh,
You still here? She's going to hate me.
Two questions. One is from the previous slide, future-oriented financial information.
Yep.
yes.
I guess, how do you really go I'm assuming it's talking about like creating forecasts possibly
Yeah,
for
yeah,
the client. And, you know, I've seen that and done that and worked with the external accountant. You take it to the bank sometimes for different reasons. And so I guess, how would that be covered in context of what we're talking about here, and how would you go about
Well, in
it?
the public practice manual, I'm pretty sure there's a section that deals with
okay,
that.
okay.
So that's
there is.
probably where you would go.
Okay, all right.
In terms of the type of report, in terms of, there are specific packages you can buy where it'll actually provide you with a lot of information where you're actually detailing who the owners are, their educational background, and then beyond that, the statements are part of that. So depending on what kind of a CGA you are in terms of what your engagement is, it could just be strictly financial statements, or it can actually be a business plan that includes the financial statements and everything else, right? So what we're saying is the financial statements themselves should be done in a compilation format, meaning that it has a notice to reader attached to it, and it'll be specific. So go to the public practice
All right.
manual, you get it there.
Sorry, the other one is, I don't know, you may run into an engagement that you want to kind of, I guess, walk away from now.
Yeah.
And you had it you had a client for a few years, and for whatever reason, you kind of do not want to continue with that client, I guess. And what is the right time, if there is a right time, and how much in advance you want to give such a notice to such a client? And
Well, the right time is definitely when you believe you're associating with false or misleading information.
okay,
That's definitely the right time. If it's just the way the client is, you don't like the way the client, he always shows up the last minute. If your fee is X dollars, he cuts it in half. If it's those types of problems, then it's just simple. Saying, okay, it's been a good ride, but this is the last year. Or you tell the client, say, look, I'm not prepared to continue, but what I will do is I will do one more year, and then beyond that you go somewhere else. All of that has implications on your final pay and everything else. So you've got to. It is a little bit delicate, but if you're concerned that you're associating with false or misleading information, well, then it has to be immediate.
okay, all right. And you always have to send a letter, I guess, for any of these actions.
You can do it. You can do it by letter, or you can just verbally say,
it's acceptable too.
once this engagement's finished, I'm not on for next year. Yeah.
Great, thank you.
Like I said, just do that as common courtesy. The sooner you do it, the less you have to worry about. So in other words, if you just finish the year end, it's already May, you have no intention, you're just tired of the guy, like if I were the girl, like at that stage, as John said, like no real bad issue. It could be a personality class, or you're just tired of arguing about the fees, worrying about the client. Say, look, you're just driving me nuts, sir. That's quite possible. The person may be too familiar with it. There could be a lot of various reasons. So just be upfront with the guy and say, here's the year end. I mean, you shouldn't try to be devious and make sure you got your pay or whatever the case may be, but obviously you got to be aware of that. If you send him an invoice and he hasn't paid you or she hasn't paid you, you at least like to make sure that the fees are paid, and then probably right after that, thank you very much, as John said, very courteous. But you know what? I'm a little bit too busy right now. If you want to be tactful about it, I think you better find something. I'm thinking about retiring, or I'm doing something else. Or
Be careful on what you put in writing too.
Yeah, well, writing you got to be a little bit more. You got to be a lot more careful, or unless you're being taped.
Yeah, that's why we're telling you to be careful on what you put in writing, because it is being taped.
That's right. Okay.
You have a question?
Okay, so now we actually have two questions.
Oh, two. Oh,
But one question is relevant to what we're talking about right now. This question is, in terms of the engagement letter, is it required every year?
I can answer that. The engagement letter, it's not mandatory that you have to have it every year. My recommendation is that you're better off to have an engagement letter every year because if there is a problem and litigation becomes a factor, it's a lot easier to reference the engagement letter with the statements that have been produced. But at minimum, you need an engagement letter every 3 years.
Okay,
Second part?
great. So the second question kind of goes back to the conversation that you were having with us about planning and knowing your client and building that relationship. It's more general. The question is, what would we do if we have been approached by a client for compilation work? After consultation with the previous accountant, that accountant advises us, just give me one second, because we had another question, and scroll down. So what would we do if we were approached by a client for compilation work? After consultation with the previous accountant, that accountant advises that though we can have all the copies of the previous working paper files, they would advise that we not deal with that specific client. So the question really is, how should we handle that?
Okay, that's actually a good question. Just because the previous accountant says, I will give you all the documentation, but don't deal with this person, it's your choice whether or not you proceed. Because just the fact that somebody says don't deal with them, it doesn't necessarily mean they're not giving you anything concrete. If they're specifically indicating that something illegal is occurring or there's an issue there, then I think you would have to go further. But you would never get that kind of a response, believe me. The previous accountant, first of all, would be very careful on what they would put on a letter. And just putting on a letter, if I was you, I wouldn't take this client. Well, what kind of a comment is that? You've had the client for how many years and you haven't given it up, so it doesn't make a lot of sense. It's just too
open-ended.
Yeah, too open-ended with nothing specific on that.
So you probably would have to talk to the person or whatever the case may be. Okay, can you elaborate a little bit more on that? So the person may or may not want to respond to you.
And review with the actual client as well.
Well, again, that goes back to when you got a new client, the integrity of the client. So maybe that may give you a little bells and whistles. Maybe I should look at this a little bit closer and talk to this guy a little bit more in detail. Don't assume the accountant's correct and don't assume that the client's correct. Maybe between the two of them, you may come up with an answer that you're satisfied with. If it's purely fee basis, you got to be sensitive to that there. Because my first comment, I can't say the guy overcharged or whatever, because I'm not too sure what he, she, or they had to do to get to this stage. So it's a little hard to say, just because the person charged $5,000 last year, he overcharged you. Who knows? It could have been a dog's breakfast, and they had to spend a lot of time and energy. And if I was him, I would have charged $10,000, so the $5,000 was very, very thick. But obviously, if the fee went from $2,000 to $5,000, then that would be an indication there. So you got to watch out there, and you don't want to say a comment, as John said, because you're worried about being sued, that you're defaming the other accountant, telling him that he's an idiot or she's an idiot because she's overcharging. So it's also common courtesy.
The most you're probably going to get is the other accountant tell you, not in writing, but well, I'm still waiting to be paid. And in your situation, you would say, well, I need these documents, and I'll talk to the client. That he obviously, you don't want to start off with a client and say, don't worry about paying your previous accountant, because believe me, what goes around comes around.
That's right.
And eventually you could be the other accountant. So you always want to be courteous to the other accountant in terms of making sure that your client is moving on, but respectful of whatever. If there's an issue in terms of the fees, in terms of what they've done, and there's a dispute, there are dispute mechanisms. They can go through the institute if it's a CA. They can go through the association if it's a CGA. They can go the legal route. There's all sorts of things that can happen, but you should jump in and say, well, yeah, okay, you know what? Don't pay him. I know the kind of work he does. No, you don't want to get involved in that at all.
Like I said, most changes are usually, unfortunately, related to fees, but a lot of changes also have lack of serviceability. Remember when we went through the previous slide? You want to lose a client, don't service them. So like it says, usually when I've taken over a lot of clients, it's the guy, yeah, I do this stuff. I give him the information in April. I don't get the information until October, and like I've got to file these late filing charges and whatever the case be. He never returns my call. Always seems to be too busy. So and he doesn't really pay attention to me, or she doesn't pay attention to me. So remember, you got to service your client there. We went to this one seminar where the guy was, the guy was talking about. He said, yeah, Bob's great. He brings in $150,000 worth of new clients every year. Then we go back to the scenario, we find out that, the reason that he brings in new clients every year because he never services the previous clients. So all he's doing is rolling over. So you really don't need that type of person. You want to have like 150 one year, 150 the next year, 150. You want to keep on building. You just don't want to replace all your clients by brand new clients, because that creates problems within the firm too, because lack of continuity, other information like extra
First
flows.
time's a lot of work.
That's right.
Yeah. So what do you think, Bruce? We take a
How
break?
about we take a break for about 10, 15 minutes? No more questions, right? Okay, good.